Hello traders and investors, Will back here with another one, coming to you with a Tuesday market recap. Hopefully you guys had a very good day in the markets today, and that you had a beautiful longer weekend as well. And in today's action, well, the volatility in the market choppiness continues at this point in time. The SPY with a very volatile day, starting off with a big red movement down here. The SPY was down about 1% in the early hours of the morning, and the QQQ much more than that. At one point this morning, at the peak of the drop, it was down 1.5 before those two indexes closed roughly flat. The volatility has been playing a big part in a lot of these massive market swings. The VIX opened up the day close to 23 before ending down there at 20. And we know that this market environment is somewhat challenging. There's a massive rotation underway, which we've been talking about for a better part of the last 2.5 weeks. And we've been talking about the number of catalysts that have been leading to this rotation. Several fears around AI, etc. The big tech spending in terms of their free cash flows towards more capex, and obviously other concerns such as the unwinding of the Japanese carry trade, the sheer amount of margin that retail investors have been carrying into 2026, the new Fed nominee in the name of Mr. Warsh, which has sent a bit of turmoil in the markets in relation to some policies that he held about 10-15 years ago, being somewhat hawkish for liquidity in the markets. So many different aspects we've been talking about for the past 2 weeks, and the market has kind of had to move through all of these in unison as we keep seeing these rotations between various different sectors. So in today's video, we're going to once again recap everything and just paint a very clean picture of where the market is possibly heading into the near-term future and why we might have to expect a bit more volatility on the horizon. So speaking about today's video, guys, very simple. We're not going to cover earnings today. Not that there's not any interesting companies. There was Palo Alto Networks, Cadence, and a couple more, of course. We can largely see that most of the big earnings are out of the way. The biggest one for this week, arguably, will be Walmart. Walmart's been on a stellar run to start off the year 2026. We will see if during their earnings they're able to hold up those gains or if the stock has ran a little bit too much into those earnings overall. So we won't be covering earnings today in favor of spending more time on the charts, more time doing sentiment analysis, and just deriving where the potential opportunities currently lie in the market, because we know in this market there's something for everybody. Dividend investors have been doing really well since the start of the year, as several sectors such as materials, industrials, utilities, and consumer staples, and even energy have been leading the way to the upside. But there's a whole other cohort of investors that really enjoy buying tech stocks on these dips. So there really is something for everybody in this current market. It's a very exciting market, and market where information moves very fast. So today we'll be spending more time on the charts, more time speaking about the rotations rather than covering earnings. That being said, in the video, we will be doing our technical analysis rundown of the SPY, the Qs, and most of your major indexes. Take a look at the rotation, where it is, where it isn't. Thereafter, we will take a look at our big tech name list down here. Many big tech companies are at very good discounted prices right now. We'll derive what are the best possible levels for entry and also derive how sound are these companies fundamentally speaking. At the very end of the video, to wrap it all off, we will do a little bit of a biggest gainers and losers segment, which is everybody's favorite segment of these videos. Take a look at some names that were down today again, and then some names that were actually recovering a little bit today, and derive whether or not there's some good opportunities in either some of the names that were green or red on the day. And that should be pretty much it for today's video, guys. So I'll have to keep it a little bit shorter than usual. And I have a boat to catch in like an hour and a half, so I can't stay here forever. But that being said, let's get right into the action, guys. I'm on an island in Cambodia. It's beautiful, but gotta change location. So let's get this video underway, shall we? So the S&P up about 0.16 today. The Qs down about 0.1. That being said, your market rotation still continues at this point in time, right? On the one-day relative, well, the rotation finding its way somewhat back into some of the tech names, but you can see the tech landscape remains very mixed, right? Some semiconductor companies did well today, some other ones not too good. Moving on to the software layer, software continues to be one of the pain points of the market right now. Your IGV software ETF still remains at some of the lows that they printed just about a week ago, so no recovery just yet, but no new lows at the same time. Seems that the volatility has somewhat dissipated in relation to the last 2-3 weeks where it was just straight shot down. Right now we're trying to establish some form of a local low in around the 2021 highs and the tariff lows of 2025 as well, so keep that in mind. Financials having a very good day today. We were saying in the past few weeks that the banks on pullbacks were very interesting opportunities, but the credit card companies as well. Today they showed some signs of life. Healthcare was a bit mixed, and the bottom half of the market, which has been your true outperformer, they took a little bit of a well-deserved breather today. So that being said, your market rotation not that that bad, right? A few more names that were expanding than contracting today, which is always a good look. On your one-day relative, you can see that even better, to where half the market was expansion in expansion territory, and the other half of the market, the bottom half of the market, which did really well to start off 2026, they are in a well-deserved pullback right now. Materials, defensives, energy, and communication services a little bit to the downside. Your 1 week relative still shows the duality of the market right now, to where the bottom half of the market, in spite of today's pullback, still has been your best performer over the past 1 week. Utilities, real estate, healthcare, defensives, and industrials, once again, and to the downside, well, communication services, financials, technology, and consumer cyclical. So keep that in mind. The year-to-date performance really shows what's been working this year and what hasn't been. Communication services, cyclical, technology, and financials, all very major components of the S&P, which is why it's been a very push and pull chart in terms of the overall SPY, right? The SPY hasn't really moved, arguably, in the past, at this point, 4 months overall, pretty much since we hit these highs in October. So call it 4 or 5 months at this point in time. The Q is kind of even worse, right? It's a bit of a wider range of consolidation, but a range of consolidation nevertheless. So please keep that in mind. If my chart, the QQQs, will actually load. Sorry, let me reload the page real quick. I guess it overloaded the cookies on me. As you can see right here, the QQQs, I guess we're going to block those. QQQs have been range bound for the same amount of time, right? But just in a more volatile fashion. So that being said, the rotation is still underway, and your best performers have once again been the more value-oriented, more defensive aspect of the market. And last week, we spent a whole bunch of time talking, or rather explaining the reasons why, especially in Thursday's video, guys. I spent the first half hour of the video explaining why the rotation is underway, what are the catalysts behind it, and all that good stuff, right? Take a look at the fear and greed index right now. We're still currently in a fear read. This is not sentiment. This is just a read of several different statistics in the market. You'll see that market momentum is at extreme fears, as the indexes haven't really moved. The long-standing moving average is catching up to the current share price right now of the S&P 500. Now, the more distance that you create between us and the 125, well, the more greedy the conditions begin, right? The closer you become, or if you're under it, the more fearful that the markets become, because they're unable to generate enough momentum to sustain the price, right? Stock price strength. This is what's curious. This is the duality of the market right now. The market breadth right now is very good. It's just that all the small little companies that have been working this year, they are not enough. They're not enough to hold up the weight of this 40% of Mag 7 names, right? So that's been the underlying problem in the market, which is why your stock price strength is good. Your stock price breadth indicators are very good as well. They are in extreme greed and greed categories respectively, but still the indexes don't move because you need the Mag 7. Put in call option ratio, that is at extreme fear, as people have been buying protection a lot in the past 2-3 weeks, as the narratives have made their way through the markets too, and the VIX remains at an elevated fear level too. So as you can see, that's why the market is currently in a fearful environment, not neutral anymore, but no, fearful, because even though you have strong market breadth, right, the market is performing well in some of these smaller sectors of the market, but they're just not big enough to kind of uphold the damage that's been done across tech, across software, and some of the semiconductor pullbacks as well. So please keep that in mind when looking at this rotation analysis. Moving on to our economic macro elements that we have to pay attention to over the course of this week. We don't really have too much, but I didn't see you guys on Friday, so you may as well recap the CPI. CPI came in at a 2.4 versus 2.5 expected, which was very good. And we've been commenting on this using the Trueflation Index as a proxy, right? A better gauge, in my opinion, of the current status of inflation in goods and services in the economy, because this one measures over 15 million different products and services on a daily basis. So the reset intervals are more frequent, and the basket of goods and services is larger than the CPI or the PCE would show. So that being said, inflation seems to no longer be that much of an issue for the markets, at least currently still in the downtrending environment. But then again, you do have on Friday a couple of key metrics. Number one is going to be your PCE and core PCE, something that the Fed looks very closely at. And then you also have the expectations for Q4 GDP, which is a revised preliminary number here at about 3%. So we'll see how that one comes out. Those are going to be your two biggest releases for the week. Wednesday, you only have the FOMC minutes, but that should largely be a non-factor. Your next FOMC meeting, I'll remind you, will be in the middle of the month of March. So keep all of that in mind when you're looking at the current analysis. Just a quick little recap of where we stand in the markets, the duality of the markets, and the rotation in the markets right now. the same statistics that I've been showing up a while, but in case you're new to the channel, welcome to the channel, obviously. But just to reiterate, right? Consumer staples has been where it's at. Consumer staples up 17% in 5 weeks, the best performance since the 2020 pandemic recovery. Only 4 other 5-week runs have been stronger since 1990, 1991, 1998, 2000, and 2020. Keep that in mind. Consumer staples really printing some high reads right there, which is uncharacteristic for that index overall. We explained why in Thursday's video and many times over the past 2 weeks. I'm not going to talk about it again, but it's this whole cyclical rotation, right? Face value, people would assume that the market's scared, so it's rotating into value and defensives. Actually, not so much, right? It's not black and white. There's a portion of that, yes, but more specifically, the big money is feeling the desire to rotate into these names because the macro outlook is a lot more clean than it was in 2023, 2024, and even 2025, when the recession odds were a lot higher than they currently stand, right? Big money will only deploy into these sectors, well, one of 2 reasons, right? One, either they believe the market is in late cycle economics and that we're on the verge of possible collapse and it's looking to protect itself, which is not the common consensus in the markets right now. The only other reason they would rotate in these companies is just keep in mind, right? These are low revenue companies. They don't have that much pricing power either, and they really got hurt by inflation and high interest rates. And now with inflation coming down and high interest rates also coming down, it's a better picture, right? There's more returns, risk-adjusted returns in these styles of trades right now. And you can see that. I mean, these ETFs, right? They basically stayed flat because the protection trade over the past 3-4 years was big tech because of their resilient free cash flows, resilient business models, high quality moats, and things of that nature. The big tech names didn't care about high interest rates because they had pricing power. These consumer staples companies did not. So largely, over the past 4 years, this is why the consumer staples ETF, I mean, there's been some ups, there's been some downs, but if you derive an average price, it's right about there. It didn't really do anything, right? Now you finally have some expansion because of a clearer macro picture. So that's a big portion of the consumer staples trade right now. That being said, it is somewhat extended. The percentage of stocks with the RSI above 70 in consumer staples is above 50%. So it's not as if these names haven't had momentum or are at the start of their momentum curve. No. They're already overbought after about a month and a half of really powerful gains, right? Usually those companies don't move with that velocity, and this statistic shows it even better. Moving on further to the complete opposite side of that is your XLK, the tech sector ETF, which has seen the highest amounts of short interest in recent memory, right? At least since probably it doesn't show on this chart right here, but certain portions of the initial pandemic sell-off, which are right there where my mouse is. But this is huge, right? More so than tariff situation, more so than 2022 bear markets, more so than the COVID pandemic. So the amount of short interest that's been built up over the course of the past, let's just call it for the past 4, 5, 6 weeks, right? Very strong velocity here. And you can thank all these AI news headlines that have been propagated, both in terms of on social media platforms, but also by legacy media. In the age of information, right? The information now, like the pace at which information circulates is extremely rapid, right? The information gets dispersed out there in the open market extremely quickly, and people are very quick to make decisions, which is why JP Morgan has labeled it, but also we've been calling it this way for the past 3 weeks. It's kind of like a shoot first, ask questions later. Oh no, Claude and Anthropic are doing something that might disrupt this industry. All right, let's just sell all these companies and short them into the ground because obviously their businesses are going to zero. Of course, that's hyperbole, right? But that's been the market sentiment as of recently. It's just been indiscriminate selling on a lot of these tech companies. Moving on further, you can see the total put call ratio is at its highest read since either the tariff situation or even back certain events during the 2024 sell-off periods. But it's really funny, right? You can reference a few of these, such as the inflation resurgence here in April of 2024 when we had 3 back-to-back months of rising CPI. That took the S&P down about 8%, and you had a lot of short interest that was being built up, and the people were buying a lot more puts than they were calls. Same thing could be said about your Japanese carry trade unwind. You remember this is the August period of time here, this little third arrow, in which the market saw a very rapid decline after the Japanese carry trade unwind, and you had a huge volume and huge inflow of puts, and it traditionally does tend to mark local bottoms. The last time it got this high was during the peak of the Liberation Day sell-off, and that as well marked a bottom of the market. Now what's very funny is the indexes remain fairly resilient around the all-time highs, and of course we know why, right? It's because a lot of the tech stocks have been absorbing the disaster, but the bottom half of the market, if I just put this on year to date, you can clearly see, right? The bottom half of the market has been doing a really good job in trying to sustain some of these tech losses and even some of the financials losses. So that's why it's such a very bifurcated market right now, where you have a lot of conflicting statistics. Under the hood, if you look at tech stocks, you would think the market is crashing right now. If you look at insurance exposure, such as the amount of puts that are bought, or the VIX right now, you would think the market is in great turmoil. Usually conditions like these you would associate with a SPY or a QQQ being down 15%. Not the case as of right now, at least not as of just yet. And here, once again, your market breadth is showing the duality of the market, or the new reality that the market is facing. New York Stock Exchange high-low logic index right now is at a 1.82. Usually you find these levels of breadth when you're coming out of deeper corrections and the whole market rallies. That's not the case right now, right? We're at a relative top in the market, but breadth is at really strong signals showing you that, well, it's just a fraction of the market coming down, weighing down sentiment overall. So please keep all that in mind when you're trying to make sense of the current market environment. As we said to start off the year, there would be something for everybody, and there has been something for everybody. You might remember during the month of January, I made about 6-7 videos talking about the themes and stocks and possible sectors to have exposure to into 2026 to maybe diversify the bets away from tech because they had a nice macro backdrop to work. And those trades were very simple, right? They were XLP. I mean, we had XLP. It's not new, right? We've been talking about this since the end of December pretty much on the channel. XLP, XLE, you might remember we were referencing lead call options down there, looking for the 4-year breakout for some of the energy stocks, dividend stocks. I was referencing a few ETFs such as SCHD down here, and they've all, for the most part, been working out really well. Like this dividend ETF, SCHD, has had one of its best start to any years in the stock's history, right? Or in the ETF's history. It's up 14% year to date. Who would have thought, right? Usually this ETF sometimes struggles to make that in an entire year. Obviously, you additionally get the dividend yield, which is not factored into that year to date performance, but still the rotations have been very strong, very powerful. And if you're only exposed to tech, well, of course, you've been facing a lot of downside recently, as many of our favorite tech companies are down 15, 20, 25+% from their all-time highs. So keep all that in mind, guys. That's the rotation explained, a bit of the psychology behind it. We did a massive presentation, as I said, on Thursday for about the first 30 minutes of the video. So now we did one more introduction, and moving forward, right, I'll kind of start slowing it down. I'll kind of not talk about the rotation so much, and I'll kind of take for granted that you guys know where we stand in the current market environment, and we'll just start speaking about charts more and more. So thank you very much for listening to the introduction, but that's all I had for you. So now let's move into some charts, shall we? All right, so taking a look at our S&P. Well, the S&P, guys, I mean, it's not super strong, but then again, we're also not crashing to new lows. There's a few features of this chart here that have, however, been broken. Like, as you can see, right, we're once again below the 50-day EMA. The daily moving averages are curling off lower, and as you can see on the monthly timeframes too, you've kind of just been stuck here with a curling over of the monthly RSI and also a curling over of the MACD. So clearly, there isn't enough momentum to sustain an all-time high rally just yet. You will need the big tech sectors, some of the software names, etc., and especially financials to come back, because some of your heaviest weights in the index, namely the Qs haven't been moving. Financials, another huge weight in the markets, they haven't been moving since the start of January. If anything, it's just been nothing but a downward bias on financials, which is a big weight in the S&P. And even healthcare, right, for as much as it's tried, just hasn't been able to put together much of a trend recently, which is why, even though the bottom half of the market's been working, you are missing your three heaviest sectors: technology up here, financials, and healthcare. The bottom half's been doing great and trying to uphold the SPY as much as possible, but you're going to need at least one of these other three sectors to kind of join the party: financials, healthcare, or technology. And so far, that has not been the case. So that's why the SPY's been excessively weak in terms of just price action. You can't say it's really weak in terms of the rotation, right? There's money to be made all over the place right now if you know where to look. But price action alone, pay attention, guys. Line in the sand is still 676. Every time they come down and test this 676 on the SPY, they get rejected. If you do flush it and close below, though, that's your daily downtrend. And synonymously, that would also be possibly a weekly downtrend too, and lead you into maybe the final phase of monthly consolidation. Maybe that's actually what you need need for the market right now is to do one of its infamous, excuse me, I keep touching that one. Maybe it just needs to do one of their more infamous tests of the 12 EMA on the monthly time frame, right? Which would look all too natural. The SPY has often done this in times of, well, turbulence for the markets, let's call it. And right now, there are enough turbulent narratives. Now, you may not believe in them, and that's perfectly logical, right? But the question is not whether you believe in them. The question is, does it have the narrative? Does it have the juice to drop the markets into the 12 EMA for a bit of a backtest and say, oh yeah, that's justifiable. There's a lot of fear, a lot of anxiety surrounding tech right now, and therefore you can possibly head for a top to 12 EMA correction of 6-7%. Yeah, I mean, the market sometimes has consolidated off of less, so you could possibly assume that. But until we reclaim the support area, again, 686 to about 679, you can't necessarily say that, yeah, that's the bottom. You just got to let the price action resolve itself. The higher time frames don't look bad, but it is a more it is a bit of a consolidation environment in the markets right now. So position accordingly. Essentially what this means is that you shouldn't be looking for massive upside quickly. You know that there's a lot of narratives that need to kind of work their way through the markets. If you're very early to calling a bluff, perfect. But don't forget, right? The market is an amalgamation of buyers and sellers, and you got to let the short sellers have their turn at the current moment. They are having their turn. People are currently, seeing the other side of the arguments right now, to where maybe 2 weeks ago, 3 weeks ago, it was kind of just sell everything and just kind of shoot first and ask questions later. Now people are asking the questions, and they're kind of driving that, well, no, AI is not really going to take over most of these software companies. No, big tech is not going to go underwater because of all its free cash flow spending, et cetera, et cetera, et cetera, right? So people are kind of starting to see the other side of a lot of these arguments that maybe they jumped the gun on. So you got to let the market run through all these narratives, right? So moving on to the QQQs at this current stage, the Qs dangerously close to embarking on a daily continuation of the downtrend. That will be a break and close below 594. They attempted it today, but no go, right? We know it's been a bit of a daily downtrend now over the course of the past 3 weeks. So we've lost the uptrend. We've lost all the major moving averages. We are now significantly below them for multiple sessions in a row. And now at the current stage, you can see a curling over the weekly time frame. We had a nice tightening bull flag right here. Sadly, it did break bearish. So when you lose the price action structure like that, you lose the weekly uptrend attempt as well. Well, you're just into a phase of monthly consolidation. So far, for the past 4 months, it's been sideways monthly consolidation, now with a more downward bias. So keep that in mind. Where we could possibly go next is the 12 EMA on the monthly, my famous indicator that I love that much, or that I love so much rather, 9 to 10%. That would be a big drawdown on the QQQs, right? 9 to 10% to that 12 EMA. So keep that in mind. They have the narratives right now. They have the downside momentum. The short sellers are putting a lot of pressure on the markets right now, and retail and institutions so far haven't been that vocal. They're starting, right? But they haven't been that vocal in terms of calling out all these various narratives. So expect more of that over the future, but so far, it's just been a market where the short selling volume, right? A lot of the bearish volume comes in the market very early on in the day. Then the bulls kind of battle out with the bears. So far, the bears have been winning, but it's a game of narratives right now, a game of sentiment in the markets overall. Moving on to XLF financials. Financials getting a bit of a bounce here. We're into our support range, 52, down about $50. So please keep that in mind. Obviously, short-term time frame control is in favor of the bears. We are under this 200-day moving average on financials. On the weekly time frame, of course, we have lost our attempt at a weekly uptrend breakout. Unfortunately, the bears have now claimed this as their own downtrend, and as a result, you were just still in this monthly consolidation wave in financials. But you can see it, right? Even financials, they haven't really done much since August, September. They made an upswing attempt, didn't get follow through, right? But it's not as if we were here and then we claimed a level into consolidation. No, we made an attempt for it, and we're kind of right back where we were in the month of August. So please keep that in mind. Very decent level right now, 52 down to 50. It's a very strong prior resistance range, very strong current support range. Several companies have been coming down into attractive areas, such as JP Morgan, right? Coming right back down under 300, decent, close to the 12 EMA. And then you got a whole host of other banks, right? Like, let's just say Bank of America. Bank of America, if they pull back into the 52 to 50, could be an interesting location. And of course, you guys know me, right? Visa, MasterCard, for some of the longer term buys. Not talking about short-term swing trades, guys, because the bears control a lot of the momentum right here at this current moment. But for long-term buy purposes, Visa, MasterCard, SPGI, Moody's Corporation, if you guys are interested in those names like MSCI as well, right? A lot of the easy names have come down quite significantly here over the past few weeks. So please keep that in mind if you're looking for some longer term acquisitions for your portfolios in terms of some financial names. Moving into the healthcare sector right now, healthcare still no breakout, although they're trying. They do have the daily uptrend into our resistance highs of about 158. They're trying as well to go for the breakout of the tight range that we've kind of been stuck in here for the better part of the last 2-3 months, right? Since the end of November currently. The monthly was never at risk. The monthly has always just been sideways consolidation, and we've been looking for a break either way. If you somehow retrace all of this recent daily upswing here, and you get a move to the downside and crack it, well, we'll be looking for my favorite entry location for healthcare, which would be about 150 down about 145. I don't really play healthcare stocks individually. You guys know that. Matter of fact, the only two healthcare stocks that I really have in my long-term portfolio are TMDX and ISRG. So I don't really play healthcare like that. I don't really buy pharmaceutical companies, nor do I buy healthcare insurance companies. Not that they're not good. It's just not my area of expertise overall. So I'm more of a medical devices person myself. If I play healthcare, but that's just a personal choice for me. So keep on watch for this ETF. As I said, man, you're going to need XLF, XLV, or QQQ to stage some form of breakout if you want the SPY to actually start getting a bit more momentum, because if these names run out of steam, right, it's not going to look good for the S&P, and you could curl over, especially if none of this money rotates into either healthcare, financials, or technology. Then the markets will be flat with a downward bias, and you can have a bit further retracements on the S&P. Moving on to SMH right now. SMH down 0.05%, but a bit of a non-event day for the SMH. The line in the sand is still down here, 374.51. Why? Well, because we had a beautiful daily uptrend underway. And then with some of the recent volatility, you got the big flush down, you got some nice rally recoveries. So now we will try and set the higher lows and go for the daily uptrend recapture. In the event that they're not able to do that, we see further unwinds. Just pay attention who controls the higher time frames here, guys. This is your lead bull in the market right now. Lead bull, more so than XLP, more so than energy, semiconductors, right? You cannot lose the semiconductor trader. It's not going to feel good. Still in a weekly uptrend, and also still in a very nice monthly uptrend too. But there's a lot of distance here. The bulls can pull back and still be in an uptrend, so keep that in mind. My favorite way of playing semiconductors right now is playing the ones that are kind of left behind currently, that still have very strong demand for the next few years, such as Broadcom, such as Marvell, such as AMD, obviously, right? AMD, if my chart's actually going to pull up. So such as AMD currently, and such as NVIDIA, right? This is NVIDIA, right, as well. So a lot of these names that just haven't broke out, rather than chasing the ASMLs at somewhat lofty valuations. There was a time and place to buy ASML, and we did buy a ton of it down here. But a lot of these, like these and LRCX, not that they're not fantastic companies, but for me right now, they're currently holds. You can have a special little kicker in the names of Micron, or possibly SanDisk, or possibly even, for some of you guys that have asked me, right, if you want to play EWY in terms of South Korea, just to have some exposure to SK Hynix and exposure to Samsung as well, which represent a large portion of the overall South Korea ETF, let's be honest, right? So these names are all on a fundamental basis relatively cheap in terms of a forward price to earnings expectancy. And obviously we know that the memory demand cycle is probably going to last for at least the next 24 months. These trades are super extended though, so you would be buying them purely wanting the fundamental expansion if the market gives it to them, but obviously you are buying things into very large extensions without much of a technical pullback, so keep that in mind. That's the duality of those names right now, right? Some people just blind buy based off the fundamentals and not care about the charts. Other people, such as myself, we would love to see a short-term snapback pullback in order to provide good entries. That way you have a combination of great technical entry and also great fundamentals, but I'll leave that up to you guys. So up to your personal choice, right? Moving on to the IWM Russell right now. The Russell, not too bad on the day. I mean, they were basically just flat, so keep that in mind. I mean, growth stocks have been holding up well. They've been doing better than the S&P and the QQQs this year, still up about 6.22% year to date. They did stall out there mid-January and even about a week ago when they tried to go for the breakout, so we are kind of stalling right now. The daily price action is very, very choppy. Keep in mind your line in the sand is 255. If you lose that, you're right back into a daily downtrend, unfortunately, and you will just head into another leg of possible weekly consolidation, and it may just send you right back down into here, the 250 to about 245 location. Growth stocks have been the other aspect of the bifurcated market, right? It's very curious. Large caps and large cap growth in the middle, which is most of the market in terms of weight, obviously, right? They've been doing nothing. What have been performing are value, industrials, smaller portion of the market, and small caps. It's very odd to find an environment where people are favoring the defensive side of the market, but not for defensive reasons. As we've explained, it's more of a macro pivot, right? Not because the economy is doing bad. As a matter of fact, because the economy is supposed to do well. That's why they're pivoting to XLP, XLE, and also into the Russell at the very same time. If it was purely risk off and worries, you would not see the money rotate into IWM Russell at the very same time they chose to bid the value names as well. So keep that in mind. This is the smoking gun, essentially, right? That lets you know what type of move it is. So it's an overall market expansion move, an overall broadening trade. So that being said, guys, the XLP, the IWM structure still looks pretty decent. On the monthly time frame, we're a bit extended. So that's why I say in the event you get your pullback extension here to 250, 245, it might be a decent re-entry trade. So please keep that in mind. Talking about the XLP right now, XLP clearly breaking out of a massive range here. That's the monthly chart. If you take a look at the daily chart, obviously blown out on the RSI, right? Your daily higher lows are right here, 86.73. Pay attention. If you lose this while simultaneously getting a rotation back into tech, you will know that it's this sector's turn to consolidate. And this one we're going to be paying very close attention to, 85 down about 83 on the back test of these moving averages, the back test of this resistance range. That's going to be a re-entry trade, because let's just say if technology comes back in a favor and they get the rotation and you get XLP taking a bit of a breather, what's going to happen is probably not going to just snap back here and then just range bound for a while. No. They'll probably run the entire market thereafter. So please keep that in mind. The breakout is pretty good right now. So I'll be waiting for that back test to maybe establish some further positions here in the XLP trade. There's a lot of names in XLP that are currently still good deals, quote unquote, because let's be honest, right? A lot of them have been crushed for the past 4, 5, 6 years. So XLP is still a very hot sector, but I will be waiting for a bit of a pullback myself. Consumer retail right now. Consumer retail hasn't been doing too bad. You can see on this chart, very glaring head and shoulders pattern right now. So not all consumer retail names are built the same, of course, but the overall sector should be poised for a better recovery, at least in 2026 than previously in 2024 and 2025. Please keep that in mind. So your monthly chart is still looking for some expansion, but it really depends on the company, right? A lot of consumer retail names have been doing really well, such as, let's just say, the dollar store recoveries have been extremely legendary, right? Whether it's DG or DLTR, like you got a lot of some of these consumer retail names that have been performing very well, but a lot of other names, such as some of the restaurant names, like the restaurant names are very mixed. You can't say that they're all doing amazingly, right? Like Chipotle is still soft, whereas McDonald's right now is very strong type of thing, right? You can also look at a company like Cheesecake Factory. Cheesecake Factory has been doing pretty well. And then you can take a look on the complete flip side of that. Cheesecake Factory, close to the all-time highs, right? But you can take a look at some names that have just gone crushed and that haven't really made a dent in the recent share price, such as Kava. Or you can look at names like Dutch Bros, which had great earnings but are still somehow down. Or you can also look at names like Starbucks too. Starbucks is just not doing anything. So, and then there's the whole clothing brand aspect. So consumer retail, you can't say that the sector as a whole is performing well. Certain names within the sector are performing well, but for the most part, the sector hasn't really seen that broadening out, at least not the consumer staples has just yet, right? Moving on to XLU utilities right now. XLU, strong, very strong move. We were talking about this accumulation phase down there. Hopefully you guys were able to catch some of that. On the monthly chart, it was always looking for a monthly higher low. It was a very obvious trade into utilities. So looking very good for the expansion. Beautiful move. Cross on the MACD as well, looking very strong here. So if you do get a temporary pullback, you might just be looking for a little bit of a back test down here around the 45 range, potentially for some further expansion. But that's a very strong move. And we were highlighting a few of these names that are very interesting pickups, right, in the past few weeks at the lows. So Vistra being a very strong company, one of my favorites right now. Next Era Energy, I don't know how much we referenced this breakout capacity, so maybe you guys were able to get a little bit of that as well. You can take a look at some names like Duke Energy as well, which is doing very well. So all of the independent power producers, or even names like Constellation. A few of you guys asked me about Constellation down here, and we were saying like, yeah, whether it's some of the uranium providers directly or some of the more broad-based power providers, a lot of them stand to do really well in the mix. Moving on to real estate right now. Real estate also, we were talking about this one too, big consolidation. Now the bonds have been catching a bid. Now that you're getting a bit of a broadening out trade in the markets, we were saying real estate might just be next, so pay attention to it. Beautiful weekly uptrend recaptured by the bulls right now, finally starting to break out. And the real estate trade, there's many parts. You can participate in REITs. We were talking about Vici down here at about 28 bucks. You know, we were talking about O Realty finally making a nice little move there. So accumulation down there at these lows with good dividends was very solid. But we could take a look at other names like Public Storage, right? Many people don't look at Public Storage, but a very interesting play nevertheless for a REIT. And then we can obviously take a look at other aspects of real estate, such as the home builders. The home builders have been having very strong weeks so far. Beautiful start to the year. We were talking about this pullback overall, going for the weekly uptrend recapture, right? Down swings overall. Then we were looking for the beautiful weekly uptrend recapture. It's finally underway right now, and that was just a look for monthly consolidation into monthly re-expansion. So the home builders trade has been a very popular trade as well. We've been talking about all these trades, guys, for the past like month and a half, so nothing should be surprising or new to you overall. They're just very nice continuation trades, and looking for these trades to continue more so than just a month or two. You're looking for these trades to go for like the multi-year expansion phases. Now, they're not all going to look like Palantir, but you could have sustained monthly uptrends, whereas before, you know, it was a bit more challenging for a lot of these various different sectors that have been flat for a while. And the same thing can be said about energy, right? Energy has been a very popular trade recently. That being said, weekly overbought conditions on XLE and daily overbought conditions too. If you do get the rollover, because the rollover is somewhat inevitable, and eventually you will have to go for daily consolidation and weekly consolidation too, you pull back there into the lower 50s. I mean, pay attention to it, right? You're going to have a lot of nice companies going for back tests. You're going to have Chevron back testing this whole 160 range. That'll be beautiful for, right, the monthly expansion trade, breakout, retest, and possibly run on companies like Chevron, companies like ExxonMobil. They're a little bit too extended, right, for a back test. They may not fully get there, but you may have some interesting plays too, right? Some of the midstream pipelines. I'm not going to go through everything, of course, but some of the midstream pipelines we talked about for some expansion back here. Remember, we were referencing Enbridge. Enbridge is very strong. We referenced Energy Transfer as well. They've been lifting off the lows. Now, they're not the fastest companies, but they do pay very good dividends. And when they come into favor off of a nice market rotation like this, you can get a nice dividend yield, but also get some capital appreciation in a sector that is currently in favor. So keep all that in mind when you're looking at these index rotations. There's two different types of people right now, right? Certain people are going to be bidding all their favorite tech names because tech is what's low. Other people will be selling tech names at the bottom and chasing the rotation, right? It's up to you depending on your tolerance and your portfolio allocation. I'm the type of person that when things are out of favor, that's when I enjoy building positions, right? Before they run. But if you guys are looking to play momentum, there's nothing wrong with playing momentum. I think that technology is a bid, but also a lot of these other sectors that have been doing well since the start of the year, upon consolidation, they're bids as well. Like if you take a look at the defense sector ETF, right? This ITA defense sector, you know, whenever we can find some pullbacks, it could be very interesting. It's just that right now the sector is very extended. You take a look at names like Lockheed Martin, right? Lockheed Martin, very extended. Take a look at names like Northrop Grumman. They're very extended as well. Take a look at names like RTX and whatnot, extremely extended. So there's nothing wrong with playing momentum as long as you can maybe establish some sort of a trailing stop or whatnot, right? But if you see some of these sectors pull back, you know that they'll be very popular for the next 12 to 16, 18 months type of thing. So there's nothing wrong with waiting for things to pull back, playing them, then when they expand, taking a little bit of profits, rotating them into the sectors that haven't been doing so well, et cetera, et cetera, et cetera. So please keep all of that in mind, right? Now, that being said, we're moving on to the VIX. The VIX down about 4.2%. But this is one of the more awkward moves in the VIX in recent memory. Usually when the VIX spikes like this, you get some sort of a macro trigger catalyst. At this moment in time, there wasn't really one. It was just an amalgamation of tons of little tiny elements and a bunch of AI headlines, which sent a bunch of people heading to the door to buy protection overall. So we clipped into the 23 range. Seems to be consolidating a little bit right now on the VIX after a downswing. But right now, the only thing you need to ascertain from this VIX chart is the fact that it's a very nice environment to be selling options in the market on your favorite stocks. So when the VIX is high, time to sell some options, guys. When the VIX is low, that's when you want to be buying your leaps and things of that nature. So now, if you're buying things, obviously it's going to come with a augmented risk premium. So please keep that in mind. Moving on to our gold and silver analysis before we get into our big tech names. So moving on to gold and silver. Gold, I mean, they had a pretty red day, let's be honest, on the Tuesday session. Down 2.25% on gold, and silver overall on the day was down just over 4%. So unfortunately, gold has now failed the breakout. They had it going for them, right? But just unable to close significantly above the $5,075, $5,080 range. So now we're seeking to pull back a little bit. You can argue that perhaps we have lost a bit of the daily uptrend, and that is true, but on the weekly time frames, it just shows you, right? We're in sideways consolidation mode right now. There is no true short-term control by the bulls. It's just been a big battle between the bulls and the bears right now. On the weekly time frame, it's difficult to kind of ascertain what's going to happen here. Why? Because we're consolidating in the middle point of the move. So if you're looking for a larger time frame swing, it's a bit tough because the risk reward is somewhat equidistant on the larger time frames. Now, people that'll be going long have a nice clear stop loss, defined stop loss area, 4640, and you'd be charting a re-expansion to the all-time highs. But if you're looking for longer dated swing trades only with the weekly charts, it's a bit tough, right? Because we're in the middle of the move. So we're going to have to wait for more price action to evolve. Arguably, if we get the final break and close above that area, then it's a better confirmation trade, because now finally you have the bulls establishing long-term control. You can set a bit more of a manageable stop loss. I'm a bigger fan of waiting for the breakouts to happen either way to give me a sense of clear direction overall. So please keep that in mind. The weekly is still arguably in bull control. They haven't really lost anything, and the monthly obviously still in bull control too. The silver trade right now, not as strong as the gold chart. Let's be honest, right? The gold chart at least made an attempt to reset the daily uptrend. This never did. They always fell short. So once again, lower high. We will see if the bulls are able to tighten up a little bit here. That's scenario number one. Or scenario number two, go for the actual uptrend. If you get an uptrend break, the entry would go there, the stop loss would go there, and you'd be charting re-expansion all the way up there. It's not that bad in terms of trade structure overall, but doing it without confirmation just opens up the door for something like this, right? Just go long here, right? Well, then you open up your door for the unwind. So you may as well let the bulls show you if they actually want to reclaim that area and continue pushing, because as of right now, we are just simply in weekly consolidation, and it's been that way for the past 4 weeks as we've lost a lot of momentum here. And we're into the phase of monthly consolidation too. So you got to wait for more clarity on the daily time frames, guys, right? Very tough to go long silver here and say, yeah, that's the bottom. I'm just going to go long. Some people would, the more aggressive people would say, oh, I'm just going to put a stop loss here, take a long here, and then go for my take profit areas, which would be 91, 92, and then the second area there. No problem, but just understand that you're doing so without the cleanly established daily uptrend at this current time. So keep all of that in mind. Now, that's it for our gold and silver trade. Bitcoin and Ethereum, we're not going to spend too much time on these because they're not doing anything. Bitcoin and Ethereum still wildly out of favor. They were down. Bitcoin was down 2% on the Monday session. Ethereum was down just over about 0.38% overall. So crypto, there's just no momentum here whatsoever, right? You need a clean break, guys, of this now area, which is roughly 71, 72,000. No break above there. That will mean no clean daily uptrend. It means that your bears are still in control. This could be yet another bear flag at the bottom for possible lower lows. So until you get that daily uptrend confirmation, just like gold or silver, very tough to position here. The only position on Bitcoin that's doable is for a longer term position overall, in terms of building out something you want to hold for years and years and years, because the short-term price action is not very conducive for short-term trades, because you just don't have any short-term time frame control. No daily uptrend, no weekly uptrend, and monthly moves have just taken back way too much, guys. Way too big of an engulfing move to say, yep, that's the absolute bottom. We're going for pure V-shape. Not that simple overall, but we'll keep an eye on it day by day and see how the price action evolves. And the same thing can be said on Ethereum, right? You need a breakup here of above 2150 to at least get the first semblance of a daily uptrend that we've had in a long time, right? Since the early phase of the month of January. So we'll see if they're able to do that. We are currently right now below our area of support, which was 25 down about 2100. So keep that in mind. No daily uptrend, no weekly uptrend, and the monthly action has taken back just way too much of this move. So the only possible thing that makes sense here on Bitcoin and Ethereum are people building long-term positions, because other than that, you don't have any short-term momentum to really support any shorter-term call options or shorter-term swing trades, unless you're just trying to catch the falling knife metaphorically, right? And just say that, yep, this is the absolute bottom, and you just continue putting stop losses under your most recent lows, such as, either this one right here or some of this want to go a bit more wide there and target this level as an expansion. But without the confirmation of the trend, right, it's not the highest probability trade. So please keep that in mind. That's everything for our overall market rundown. Now let's get into big tech and then we'll do our biggest gainers and losers. All right, so we're talking about big tech. We're going to go through these a little bit quickly because not much has changed on a lot of these charts. So Apple getting a little bit of a lift here, 3%, as they do have a new product release set to be unveiled in the early portion of March. I believe March the 4th or March the 5th, Apple will be releasing a new suite of potential products. That's going to be very interesting to pay attention to. So that being said, Apple in the grand scheme of things, still in the daily downtrend, still under our resistance range, about 267 versus the 275 resistance highs, into support as well, 256 down to about 245. And if Apple stays down here a little bit, that's going to be an area where maybe I want to participate. Anything under 250 for me is just a better price for Apple. The clearest time frame, because you got a lot of conflict between the time frames here, right? It's a daily downtrend, but you're not too sure whether or not the bulls will be able to pull off this weekly uptrend recapture in 2 phases. The monthly time frame shows everything best, right? So you're just looking for a bit of a monthly higher low into the 12 EMA. So if Apple comes under 250 again, I might be looking to participate again. That's the last time I did participate, but haven't really done anything since. Earnings were very strong. The product releases have done very well for Apple since September with the iPhone 17 and whatnot. So we'll see what they have in store for us come the early portion of March. Moving on to AMD. AMD continues to get pushed and pulled around by various headlines overall. That being said, currently still approaching our $200 psychological support, which has been a very highly contested area for the stock recently. That being said, true support at least, stays below 190 down to 175 roughly, because that is your true previous highs from our market structure. Yeah, there's not really much here other than 200 psychological, even though they will lead you to believe that it's a very strong area because they've defended it for a while. Possibly some put walls or things like that there. So keep that in mind, right? Daily action has been lost. The weekly timeframes as well have largely been lost and unwound by our bears in terms of recent price action. We are still in a phase of monthly consolidation for AMD. So what better time to accumulate more of a position on AMD than when it's down here around the $200 range, under a 1 peg, low 30s multiple, and a 7 forward price to sales with all of this revenue and EPS growth. I'll remind you, right, even though AMD's been very choppy overall, it's been holding its price, not the all-time high price, but it's been holding close to relative highs for a reason, because this company is about to have one of the most epic growth stories in the entire market, as you can clearly see from the EPS ramp and the revenue ramp. The only issue is that, well, it's not an issue, but it's been known. We've been talking about this, right? It all comes second half 2026 and then for the next few years. So the time to position for that thesis would still be right now and is still indeed quite valid from here down through about the 180 range on the lows. Moving on to the Amazon ticker. So Amazon up 1.19%. Not too bad of a day. Amazon's been in daily oversold conditions. A little bit of a bounce out of those oversold conditions, but we obviously know short-term bears are in clear control, right? So Amazon bulls have to do everything from scratch. First, you got to reset the daily uptrend. Only when you have the daily uptrend, then we can measure the size of the move on the weekly and talk about recapturing the weekly. So a lot of room left for the bulls to embark on that time frame recovery process. Resistance above is now 216 to about 205. So keep that in mind. They got to get through a lot of price action participants right there. If we are buying it for a long-term thesis, I think that's a very good time to be buying Amazon for the long-term thesis. Around 210 or under, 27 forward PE for 2026 and a 1.35 peg. Phenomenal earnings that the company delivered. Obviously, everybody's focusing on the $200 billion of CapEx, for which they also are going to be doing a shelf offering. They didn't disclose the number just yet, but they will be doing a little bit of dilution too in order to do that. Right, not to raise too much debt capital. That being said, you'd be hard-pressed to find anything in that news release other than the CapEx spend, which is a big one, I'll give it to you, right? But all lines of business of Amazon are performing excessively well. So buying this company at $200 all the way down through support, which is about 190, phenomenal deal. One of my favorite buys in the market. I know it hasn't been fast. It's been quite slow, as a matter of fact, and we've round-tripped a lot of the gains since last May, but I truly do believe, guys, that these buys, the longer-term buys, or in my case, these leap call contracts will be rewarded before December of 2027, which is where all my leaps are from. That's why in the past 3-4 months, when I've been talking about buying leaps on a lot of these companies, I put them so far out to December 2027 because I knew that the path would be somewhat bumpy. Although the path is very certain, it will come with certain speed bumps in the interim, right? And we can clearly see no EPS issues and no revenue issues for Amazon. As a matter of fact, they'll be doing $1 trillion of revenue in 2028, which is just massive, right? So phenomenal opportunities across the board. Google right now pulling back about 1%. So Google, unfortunately, losing the uptrend. Daily downtrend lost the 50-day EMA, which Google does not do, or hasn't done rather, since last June. They haven't lost the EMA, right? All the EMAs and the 50. So that's notable to us. That's a big pattern shift. The weekly timeframes also have now been structurally lost. So please keep that in mind. It was a very nice weekly uptrend this entire time. You've now lost that. You've lost your weekly 12 EMA too. And as a result, Google is now finally embarking into its monthly consolidation phase, which we've been waiting for a while. So perhaps if Google can make its way back into the mid 270s, 280s, maybe we can find a reason to participate again, because at 330, at 350, there really wasn't that much reason to participate. The stock was at the top end of the valuation range, almost 30 forward price earnings, almost a 2 peg. There's many other big tech companies that have been trading at the 1.3, 1.4 peg range for a while. Google was always up there. Phenomenal business. We covered their earnings. Nothing wrong with their earnings. It's just I like to combine good fundamentals, or actually better, cheaper fundamentals than that currently, and a great technical entry. All the way up there at 330, 350, I was getting neither. So maybe if we can come down with a 2 handle in the high 2s, I might be more interested. Moving on to Meta, but I'm not selling any shares on Google. I'm just holding, just not buying any more, right? Meta, similar to many other Mag 7 stocks out there, guys. Meta, there's just no other way to say it, right? Meta is just super cheap right now. Below 660, you're at a lower than 22 forward PE. You're at about a 1.17 peg. Price to sales is good. Free cash flow is pretty good, but they are spending a lot of free cash flow on CapEx, and we did raise those concerns during earnings. That being said, 640, 630 roughly is your support range. Not a very big one. It's the closest one that we have. Definitely not as big as the whole 600 down about 560 range, but from here on down, Meta indeed is a great location to be buying. Not for short-term swing trading, because they don't have the short-term time frames anymore. We do not have the daily uptrend. That's now been lost. They've pulled back way too much of this weekly move, right? They could still get it done, but that's a big piece of momentum that was just lost. Then, of course, you have the good old head and shoulders prophecy that some people have been referencing with good reason, because you see it best on the monthly time frames there. I'm just here to say, if the technical prophecy is fulfilled and you revisit 600 down to about 560, that would kind of complete the pattern overall, would bring you right back down to the 26 EMA, and usually finding Meta at these valuations plus a 26 EMA, 25% plus from the all-time highs, usually the buys made down there will be rewarded over time as the company's fundamentals do prevail in the long term over shorter term technical patterns and over shorter term sentiment against the stock too. So no short term swing trades on me for now, just selling puts below the market and accumulating some long term shares. Moving on to good old Microsoft. Microsoft down 1.11%. Again, Microsoft plunges more and more and more as we now filled the gap from the April earnings. That was a massive gap to be filled, right? And they filled the entire thing. Can you imagine Microsoft still down about 28, 29% from the all-time highs? Very cheap down here. Price action wildly out of favor though. Daily oscillating oversold conditions and not. Daily downtrend obviously on the chart. Weekly, clear weekly downtrend and weekly oversold conditions. How often does that happen on Microsoft? Not very often. Does Microsoft hit weekly oversold conditions? You would have to go back to tariffs. Sorry, maybe my head's in the way. Tariffs of last year, or you'd have to go back to 2010 to find Microsoft weekly oversold conditions. When does Microsoft hit the 200 weekly EMA? This green line right here. Not very often, right? How often does Microsoft hit at the same time that 200 weekly is the 50 monthly EMA? Not that often. So there's a lot of things that are happening on Microsoft stock right now that do not happen very often. And in combination with all that, you also have a relatively cheap valuation. Under 410, it's running at a 25 forward PE, a 1.34 peg. You do not usually find Microsoft trading this cheap, especially not with this amount of revenue and EPS growth. So the technicals are telling us it's a buy, but we know that short-term momentum right now, the bears are favored. However, if we're looking for leaps, with a lot of time on them, or possibly some shares for the long-term portfolio, we cannot say that it's not a good time to be adding Microsoft, right? Historically, in terms of all contexts that we can have, either fundamentally Or in terms of the technicals, it does say that we should indeed be buying down here, as painful as it may seem in the short term. Moving on to Netflix right now. Netflix up about 0.17% today. There was some news today that Netflix was authorizing, Warner Brothers to discuss with Paramount in terms of a new deal for the next week or so. This entire deal situation has been an absolute mess. And it's funny that Netflix is actually up on that news, that they're allowing Warner Brothers to possibly be in discussion with Paramount again. It's funny that the stock is up because it just shows you, right, how a little faith the market has in this deal being accretive to Netflix's business, at least in the short term, right? They're going to have to take on a lot of debt. Obviously, they're going to have to take on, Warner Brothers' studios and things of that nature, right? So there's a bit of a business assimilation period that the stock is going to have to go through, the company's going to have to go through. It's just overall the black cloud overhang on Netflix's stock price in recent memory has been pretty much since this moment in time about the 105 area when the news of that deal broke, and the stock has never really recovered. The bears have just been in full, complete control. So no sense in talking about it more, guys. If you want to see this stop, well, you're going to have to do one of two things. Either reclaim the 12 EMA in a big fashion and then reset the uptrend, right? Or it's going to be both, where they have to reclaim the uptrends and reclaim the EMAs, because as of right now, the bears are just in full short-term control. Just no other way to put it. Bouncing off the 200 weekly EMA. Big weekly oversold conditions, the likes of which we haven't seen since 2022. And look at all of these red weeks in a row, man. It just has not been an easy time. Arguably one of the worst times in terms of just sheer price action for the stock, in terms of consecutive downside. The downside in 2022 is more pronounced, but it wasn't as consecutive as this current move has been on Netflix stock. So sub 80, where we are right now, it's a very good stock, a very good price right now. You're trading at a low 20s multiple, a 1.2 peg currently at 77, which would be very attractive for long-term shareholders. But you know that if you're holding this stock, it may take a while to get the momentum back and to turn around the sentiment, which is something that can be said for a lot of other tech names out there in the market, not only Netflix, which has its own problems, of course. Moving on to NVIDIA, a stock that at face value has no problems whatsoever, because with all this CapEx spend, who's getting most of that money? Obviously, well, NVIDIA, right? You can argue that, up the pipeline, you can talk about TSM and ASML and LRCX and all those guys and the memory companies for sure. But let's be honest, right? NVIDIA is going to get a lion's share of the money too. Now, in terms of where we are in price action, still no breakout, still no breakdown either. 185 to about 178 is your area of support. I enjoy on red days on NVIDIA playing short puts down here, selling put options in the lower 170s. It's been easy money so far over the course of the past, 4 or 5 months at this rate, right? So no current breakout, still sideways action for NVIDIA. You will be looking for the true breakout. You're really going to need it to close above 192. This 192 area has been so problematic for the stock so many different times. You need a close above 192. Keep in mind, NVIDIA has earnings next week. So I'm not sure if it's going to break out much before their earnings, but I'm sure the market's looking forward to hearing all about those earnings too, for the reiteration of the guidance and for Jensen Huang's predictions, or rather just overall guidance on where the overall AI trade is heading. At around 175, 180, the stock is trading a very low 20s multiple and also a 1 peg, which is very rare to find on such a phenomenal company. Moving on to Tesla now. I'm going to do a few last ones, and then we're obviously going to move on to our biggest gainers and losers. So good old Tesla down about 1.63%. Not the worst performance from Tesla. And obviously still, though, the stock is down about 17-18% from the all-time highs. Now, we're currently coming into a very big area, guys. 405 at about 380. We've been talking about this area for a while. 200-day EMA is buried down there too. Weekly price action structure is not the strongest, as they forfeited most of that market momentum leading into those December highs. So we're kind of giving back most of the move. However, the clearest timeframes of them all are indeed the monthly chart. It's surprising that Tesla, being a higher beta stock, with names like Microsoft and etc. being down so much from their highs. I mean, yes, Tesla is down 17-18%, but you would expect Tesla in a period of high volatility like this to be down a lot more. But what's kind of holding them up is the fact that, well, they're exposed to a lot of the popular narratives right now, which are energy and robotics specifically, right? And obviously the robo-taxi network too. So keep that in mind. Monthly, very nice area of consolidation, 405 down to 385, touch of the 12-month EMA. So I'm not building positions up here on Tesla, but I can't fault the long-term investors for still being very bullish on the company. The price action does not look that bad. And the next 5 years for Tesla, if they execute perfectly on the roadmap, could be highly interesting. Moving on to Palantir right now. Palantir continues to be an unfavorable name in the market. Used to be one of the most loved names in the market, and then it's slowly unwound. There's been a lot of drama on social media with Michael Burry and Palantir, and a whole bunch of short sellers chiming in, a whole bunch of retail investors chiming in. We're not going to get into that, but just know that this stock continues to be one of the most polarizing stocks in the entire market. Either you love the company or you hate the company based on the valuation or based on their business practices or whatnot. All we're here to discuss, though, is price, so keep that in mind. 127 down to about 117 is the next area of support. It's not the biggest one, but it's the closest one that we have. Palantir oscillating between daily oversold conditions and not. Daily MACD is trying to find a bottom right now. What you need to see across all these names, guys, give me the daily uptrends. It's very simple. Whether it's Amazon, whether it's Google, even recapturing that, whether it's Meta, whether it's Microsoft, whether it's Netflix, whether it's Tesla as well, give me the daily uptrends, and then we can talk about these potentially being local bottoms. Until that time, the bears are still very clearly in short-term control. They control the daily, they control the weekly time frame. So before you even think of this being a weekly bottom or a monthly cycle bottom, you need to get the daily uptrends first. So please keep that in mind. Palantir still trades right now at about a 2 peg. So it's down a lot from the peak end of its valuations, but still expensive. You can make a case for it, which we were saying after their earnings. You can make a case for this one, for buying this one here, if you have a 5+ year holding period. But for anybody looking for very rapid and quick expansion gains, if you're looking for Palantir to put in the same types of legs as it did from $6 or $10 or $20, it's not going to happen, right? But can you justify entries here if you want to hold for the next 5-10 years and participate in this company's story? Yeah, you can justify some buys here. Just know that you will have to possibly DCA if they do come down for the full flush in the $100 range if the market were to deteriorate any further. Moving on to SOFI right now. SOFI also same concept, right? Same concept as Palantir, same concept as the rest of them, losing all of the momentum, losing all the time frames. And we are now below the area of key structure, 25 down to about 21. There's just no way around it, right? You're below the key areas of structure. It was this area of structure that held for a long time. And now the bears control all the time frames. They control the daily time frames. It is oversold conditions. You can argue, well, since we haven't established lower lows, but the RSI is making higher lows, maybe there's a bit of bullish divergence. Yes, perhaps, but still no resolved daily uptrend. The weekly is still in an overall downtrend too, and the monthly lost a major level and is still embarking into the larger phase of monthly consolidation right now. So the way that I enjoy playing SOFI is, yes, am I bidding here? Absolutely, but I also fully acknowledge that I will have to DCA down there if they go for the full retracement towards the 200 weekly moving average. So you should keep that in mind as well. That being said, under 22 bucks, I mean, it's about 10-something% lower. It's trading at a low low 30s multiple with good revenue growth, great EPS growth, and about a 1 peg, and also about a 6 price to sales. So not the worst metrics overall for SOFI Technologies, but keep in mind it's just in a big phase of consolidation. So any buys here should really be done methodically, right? And not maybe all at once. Moving on to Uber right now. Uber's another example of a very solid company that's just got a wave of bad price action. The daily bears are in full control of this chart. No secret there. Daily oversold conditions, daily downtrend. So you need to do everything from scratch. Give me the daily uptrend. Then we could talk about, all right, how much of this move can the weekly bulls get back? Can we reset the weekly uptrend? And only then will you know that you found a monthly structural low. That being said, if we're looking for long-term investments here, very good. Under 75, low 20 forward multiple for about 13.4% revenue growth per year at 20% EPS growth. The PEG ratio also is sitting at a very cool 1.11. So Uber has very low valuation metrics right now. Part of that is because obviously they are, in the bullseye of a lot of the AV, right? The autonomous vehicle narrative right now. Although they are a very powerful network, they will be able to use that network to their advantage to partner with more and more AV companies, right? They've just been sold off. So if we were looking to start a position on Uber, this could be a very decent time. Just keep in mind, if the bearish price action continues, you're coming down to the very large support area of structure, which is low 60s, which are the 2021 highs as well. Imagine that. Back again to some of the 2021 high areas or the lows of 2024 and the tariffs of 2025. And now lastly, good old TSM, so Taiwan Semiconductor down about 0.6% on the day. This one has held up better, in my opinion, than most companies out there on this list, or even most companies out there in the market. Sorry, let me refresh my page again. My bad. Bear with me. That's why I film these live, so you guys can see the technical issues as well. Moving on to, that's not TSM, TSM. So TSM down about 0.6%. They're holding very close to the recent highs of about $380. So daily price action structure is super, super strong. This is a fake candle. Don't pay attention to that. So if we do retrace a little bit more, you're heading down into the 350 range, maybe for a bit of a breakout retest. The only issue with this stock right now is the fact that it is quite extended on your higher time frame. So you guys know me, right? I'm a big fan of waiting for the higher time frames to pull back into structure such as the weekly 12 EMA, or if you want the larger trades with larger size, you got to wait for it to pull back into the 12 EMA, things of that nature. It's just a bit extended right now on the higher time frames, which is fine if you're just holding, because I see no reason to sell right now. A bit more challenging to start a position all the way up here, as we know that at 340 the stock isn't super expensive. So this one is kind of like, you know, it's the same premise of Micron or SanDisk, right? Although, of course, TSM is more expensive on a forward price to earnings basis or a peg basis or things like that, right? It's just the same type of trade. You're buying things at highs with big momentum, knowing that there's a huge demand for their products, and you know that you're not getting the best technical entry. The fundamentals can be justified even up here at 364. It's just not my favorite type of trade. Usually I enjoy waiting for pullbacks where not only does the fundamental story make sense, but you know you're getting a very nice technical area of pullback too. So TSM a little bit too extended for me. This stock remains a hold in my category. A very strong company. It's just I'm not buying more up here. And that concludes our overall market rundown. Hopefully you enjoyed. Now let's spend about 10 minutes talking about the biggest gainers and losers of the day. As a matter of fact, we'll do better than that. I'll just go through this list here and I'll just tell you which names I'm looking at specifically for longer term positions, because we talk a lot about trading. We talk a lot about the rotation in the markets right now, and we've talked about some of these neo cloud providers a ton, but I'll reference some names that I'm very interested in over the next few weeks to kind of build longer term positions in across my portfolios. Names that haven't achieved or haven't come back to these prices in a very long time, but they may be worth your attention for a second look. So let's get into some of those. So number one, we can talk about some of the software names, guys. And arguably, if I'm going to take a software mean reversion trade, I'm not going to go for everything. Now, special shout out to companies like Adobe that have a very cheap valuation right now, right? Names like Adobe. I think Adobe right now is trading at a forward like 10 or 12 PE. Give me a second. The chart is going to load in a bit. There's names like Adobe right here at about a 11 forward price earnings. There's names like Salesforce that are also pretty cheap. But if I'm going to play any of the SaaS names overall, my two favorite picks arguably are Intuit, all the way down here at 2023, 2022 prices, and maybe a company like ServiceNow. Those are for large cap SaaS plays, right? I'm not playing them individually. I am playing IGV as an ETF as a whole, though, as I do believe that it's maybe easier to play this one as an old ETF sector, because you're not quite sure which names will recover the fastest in the overall software trade, which is why I'm playing shorter term call options on the IGV ETF overall. The largest weights in those are Palantir and Microsoft overall, but you can make a case in point for names like Intuit or names like ServiceNow for a longer term portfolio, as I do believe that those are some of the two of the names that maybe aren't as easy to be disrupted. Obviously, you can make a case in point for Adobe, you can make a case in point for Salesforce, et cetera, but my two favorite ones, if you're just asking, are Intuit and ServiceNow at the current moment. Now, in terms of SanDisk and Micron, we referenced them before. These are just trades that, if you're interested, right, they haven't had much of a pullback opportunity, but if for ever which reason, guys, we come back to the 12 EMA, if SanDisk retests 500. Now, some people won't say that's possible, but anything's possible. And if Micron retests down here like the 350 range, if we're looking to make momentum swing trade longs, those would probably be the areas to do it. So keep that in mind. Or you could also do the same thing on EWY, right? If EWY, South Korea ETF, which is largely led by SK Hynix and Samsung, let's be honest, right? You get a nice pullback here to the 12 EMA. That could be a nice re-entry opportunity for momentum. I mean, look, it's done it so many times since, right? So you may as well just repeat the patterns that were previously underway on some of those memory stocks. Now, some of the names that I'm looking into recently that have had significant sell-offs that are, in my opinion, kind of like one of ones in the market right now. Axon 200 weekly EMA. You guys know the drill. You find something around the 200 weekly EMA, which is with a strong business model, it could be worth a second look. So Axon, I really love the business overall. I think they will be having earnings over the course of the next week, so I'll try to cover them on the channel, but this is one that I'm highly exploring in the lower 400 range. AAPL is another company. We covered their earnings recently. They had phenomenal earnings growth, phenomenal margin expansion as well, trading at a very, very cheap valuation, one of the cheapest that they've had in a very long time. This one in the mid 300s, I'm also very interested in as well. Shopify, another company that's arguably a one of one or their e-commerce prowess. Now, this one too, this one is not as cheap as some of the other companies that we could talk about, right? But it is a very strong company with an extremely strong business model. I love the earnings presentation that they gave us last week. So Shopify in the low 100s all the way down to about 90 bucks. I think this one is a very solid opportunity to be picking up if you are a longer term investor looking for some of these very high quality businesses with good competitive advantages, right? Trading at a very nice discount from their highs overall. We can also reference one of my newer buys that I was doing over the course of 2025, which is a company called ISRG, right? ISRG, I don't talk about that often, but if my chart would load, sorry guys, I'm not too sure what's going on with the charts today. Trading view appears to be slow. ISRG, right? From where we are right now, all the way down to the mid 400s, phenomenal company. And the mid 400s to low 400s, this is the 200-day EMA. So buying here, if we're just talking about buying and DCing and building a position, this little pocket from where we are right now down to the 200 weekly EMA, you could see it, right? Usually the company respects this 200 weekly EMA all throughout its history of the past 10 plus years. So these are the moments in time during big phases of consolidation. I'm not saying it's cheap. It's not cheap. We covered their earnings when they released them January 22nd, right? It's not a cheap company, but the reason that a lot of these companies are not cheap is because their moats, their competitive advantages are very, very, very strong. And they also have beautiful growth rates to kind of complement those competitive advantages. The companies that I'm bringing you up, like Axon or ISRG or Shopify, you know, they're kind of one of ones in the market. You can't really find companies that do what they do. You can find somewhat, you can find some proxy competitors, but nothing truly like these companies. So please keep that in mind, right? So those are most of the things that I wanted to kind of take care of over the course of today. Obviously, you can look for some pullbacks on the XLP names. If we're looking for pullbacks on XLP names, I'd rather play them as an ETF, as XLP, but in the next few videos, I'll try and bring you guys some more value plays if we can find them on the pullback, such as some oil and gas plays, or possibly some, consumer staples names, or some industrial names like UPS or, Pepsi, etc. I'll give you guys some levels to play them on the pullbacks, but just don't have enough time for them today. But those are a lot of the companies that I'm looking into. Obviously, you guys know that I'm a big fan of buying these big tech dips right now, but outside of big tech, I just wanted to show you some other companies that I'm highly considering building positions in, some of which I already have positions, some of which I don't. Like I don't have positions in Axon right now, but I do have positions in ISRG, in Shopify, and I do not have a position in AAPL, but I would be somewhat interested. I don't have a position in Intuit. I'm not really playing the software names like that. I'm playing them with IGV. So I'm just telling you guys which ones I'm playing with ETFs. Like software, I'll play with an ETF. Consumer staples on pullbacks, I won't play them individually, but I will play them with an ETF. Oil and gas names, I won't play them individually, but I'll probably play XLE on a pullback. So that's just how I'm playing things. Feel free to be inspired from that, or dissect the ETFs if you want to the downside too. But that's it for me today. And you guys already know TE Energy, big fan of this small cap name overall. So we'll be covering a bit more of the names in the next few videos, but that's it for me. I really got to run right now. So hopefully you guys enjoyed today's video. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Also consider subscribing to the channel. If you're new, we'd love to have you back. We do these videos every Monday to Thursday while I'm traveling. And last but not least, if you have any questions or comments or feedback, or you have some trade ideas that you wanted to share with the group, definitely leave them down below in the comment section. We'd love to hear from you guys. That's it for me. Take care. See you guys tomorrow after the market close. Have a good day in the markets, and peace.